What's up, guys? Welcome to the channel. Today we're going to talk about how to structure an infinite bank, what those look like, and how we can actually utilize them. Because a lot of people, they don't quite understand of what an infinite bank is and how you can actually utilize it. Okay, so with an infinite bank, what we're looking to do is we want to take control of our money. And so what does that mean for us? So when we look at the infinite bank, what we want is to create a vehicle, our bank. And now our bank is going to be, traditionally, it's going to be a life insurance policy. Now, you can actually do an infinite bank with many other things, but the most common one is going to be a life insurance policy. It's the same thing that what the wealthy do. So what we're doing with our bank is we're just putting our money into it, okay? Now, in the beginning, our seed phase is going to be a little bit on the slower side, as we're not going to gain our money and we're not going to get cash on cash. But what we're able to do is eventually we're going to have quite a lot of money in here. And so with that money, the insurance carrier, they're going to guarantee us a dividend. Well, they can't guarantee a dividend, but they're going to guarantee a growth, and then they're going to pay a dividend. They paid dividends for the last 100 years, so I can pretty confidently say they're going to pay you a dividend. So anywhere, you're going to see that dividend anywhere between 4% to around 6%. Okay, now I know what you're thinking. I can go put my money in the S&P 500. I might be able to get more. Now, the pro of this is going to be that is going to always be there. So if you have 100,000, that's always going to gain that interest. And if you need to utilize that money, you're going to take a loan. So your 6% is going to be compound. While if you take a loan for $50,000 to try and make more money on your money, that's simple interest. That's just an advance of your death benefit, okay? So what you're utilizing is you're having your policy put up with compound interest, and then you're using the money inside of the policy in order to go try and make higher interest rates. So another way this is used is you'll see it with the ultra wealthy, where they'll take a loan against the equity that they have in their company. They're doing the same thing. They're saying, I'm going to take a loan against this thing that I own, and then I'm going to utilize it. The only pro with this is the barrier to entry to be able to get a whole life policy to be able to do this is very low. So what you're able to do is create an asset that always stays with you. Can't take it away from you. And so what you're able to do is you're basically able to own all of your money, and then you can utilize it from that point forward. Now, some of the benefits is obviously going to be you're able to control your finances. And the pro of once your money gets put in here, it's going to be similar to like a Roth, right? Once that money's put in, it's never going to get taxed again. When you take the loan, it's debt, it's tax-free. When you die, it passes, tax-free. So what you're able to do is, instead of putting all of your money in like a 401k that's going to get taxed on the end, what's going to end up happening is that cash value is going to keep growing in these types of policies, but it grows tax-free, and you're able to take loans tax-free. So what you're trying to do is just create a vehicle. It's not built overnight, but what you're able to do is create a vehicle to where you can put your money in. It's safe, right? There's been 500 banks go out since the 1900s. There's only been one life insurance company. So your money's very safe in there. It's what the rich used to do. And so what you're able to do is just take control of all of your money, and it's a great way. So now when we look at these, how are we going to choose the right insurance policy? There's only a couple carriers that can do this, because what we're doing with our policy is our cash value that as we're going to pay in is going to continue to go up. Now, a lot of times when you talk to Dave Ramsey and all that stuff, right, a lot of those are going to have a fixed cash value. And so as you pay in, you're never going to actually get ahead. While with an infinite bank, what you're doing is you're stripping away the insurance portion of it. And then you're saying, what's the minimum amount of insurance that I can carry for the maximum amount of cash that I can put in and not break a tax code? So that's how those are set up. So what's going to happen is eventually your cash value is going to butt up against that insurance. And at that point, the insurance carrier, you're actually less risk for them. But you still get to utilize that policy to do whatever you want. So with that, like if we take it and let's say we want to buy a car, right? If we've paid in, let's say 50,000, right? We have 50,000 in cash value, and let's say we want to buy a car for 25,000. Well, the thing about it is, when we buy that car for 25,000, instead of going to the bank and let's say they give us a 6%, it'd probably be a little higher, but say a 6% interest, right? What we can then do is we're getting 5 to 6% on our 50 grand. We take the loan, so we're getting 5 to 6% here. Then we're going to take the loan for 25,000, and then we're just going to pay ourselves back like we normally would. So we're going to recapture the interest, because this interest right here is simple interest. This is going to be your compound interest. So what you're going to end up doing is you pay a substantial amount less in interest while you pay a little bit to the carrier. It's substantially smaller, but your bulk of your money is always staying in the right spot. Okay, so that's what you're able to do. You're able to just hold all of your money in one spot, and then you utilize it for things. So people use it for down payments for real estate. You hop on a deal, what do? You get your life insurance policy, you make the down payment, and then you pay yourself back. So what you're able to do is utilize your money, but at the same time, your money's going to sit in a spot to where it's always going to gain. And so some misconceptions that I do kind of want to address is this is not an IUL, okay? A lot of people are going to confuse this with an IUL. An IUL is not going to be the type of product to be able to do this with. The reason why is with an infinite bank, you're going to have a fixed cost of insurance, and an IUL, you're just not. So what's going to happen is over a long period of time, the IUL is going to continue to cost you money, while the infinite bank, while you don't get the death benefit of an IUL in the beginning, on the back end of those policies, they can pretty much completely self-fund. Many IULs, you can't do that because your cost of insurance is going to go up over time. Now, if you want me to do a video on the difference between an IUL and like an infinite banking setup, I'd be more than happy to do that. I can draw some stuff out, but I want to kind of address that as an infinite bank is going to be a different setup type of policy than what an IUL is. I'm not saying IULs don't have a place, but I would just say most of the way they're marketed, you're going to want an infinite bank for what most people are looking to do, while an IUL is going to fall short of that. So that's all I have for you today, guys. If you liked the video, please like, comment, subscribe. There is a training for new insurance agents if you're just getting started. Or if you do want to work with me, I'll put my link below. I'm more than happy to answer any questions or anything like that. Thanks. Bye.